Trump likes tariffs. In fact, he says it's one of his favourite words. But economists are almost united in saying that tariffs will push up prices and lead to lower growth. And if Trump is unable to enact the biggest increase in tariffs since the 1930s, how will it change the global economy? Well, in recent years, the German economy has been struggling. An 18% decline in industrial production, economic stagnation, and the economy relies heavily on exports. 10% of all German exports go to the United States. Could a global trade war between America and Europe be the trigger that pushes Germany into a long-term deindustrialization? At a Trump rally, Trump made his thoughts crystal clear. I want German car companies to become American car companies. I want them to build their cars here. The problem for European car firms is that they are already losing out market share to China and other Asian companies. The collapse of Northvolt, Europe's best-funded battery startup, is symbolic of the difficulties that European car firms are facing. Whilst Chinese electric vehicles roll off the assembly line selling for less than €10,000, European firms, who once excelled in the more complicated mechanical engineering of a combustion engine, are falling behind in the new electric era. And it is worth noting that this German industrial decline began before gas prices went through the roof. Ironically, the energy crisis of 2022 and 23 would have been much worse if it wasn't for American liquid gas replacing a lot of the cheap Russian gas. After placing so much faith in cheap Russian gas, it would be unfortunate for the European economy if the United States became a thorn from the other side. It's not much better for the UK. Since Brexit, UK trade has suffered very slow growth. The UK car industry is suffering, with the latest figures showing an 18% decline. The recent news about the likely closure of the Vauxhall plant in Luton is symbolic of the difficulties UK industry is facing. The US is the biggest single destination of UK exports, with $60 billion in 2023. The great hope of Brexit is that it would enable a free trade US deal and replace some of the lost EU trade. But now there's a reasonable chance that trade favourability with the US will worsen rather than improve. It leaves the UK isolated between a struggling EU bloc and a protectionist US. It may force the UK to make a difficult choice between a US trade deal with all its chlorinated chicken or try to edge closer back to the European Union. Either way, it heightens the UK's vulnerability post-Brexit. The UK is running a trade deficit with the US, and if Trump loves tariffs, he hates a trade deficit. And the US has a really big trade deficit. In 2023, the US had an $818 billion current account deficit. With China, the US trade deficit was $280 billion. That means the US is importing far more than it is exporting. Trump wants to reduce this and has even floated the idea of 60% tariffs on China, if necessary. A shrinking of the US trade deficit would definitely have big consequences for the global economy, but not what you might imagine. The thing is, if the US has a trade deficit of $280 billion with China, it means the US also has a capital surplus of $280 billion too. To put it in simple terms, US consumers buy cheap mobile phones from China, but that isn't the end of the story. Chinese individuals and firms are simultaneously investing foreign currency back in the US, buying US treasuries, making it cheaper for the US government to borrow, or investing in factories and supply chains. That's how the balance of payments works. If China didn't invest back in the US, the dollar would devalue and the yuan appreciate. So if the US trade deficit fell back to zero, so would its capital surplus. If you eliminate the trade deficit, you reduce capital flows. And at the moment, with the US economy doing relatively well, it's attracting a lot of capital investment, and a trade war would probably cause this to decline. Now the big question is, could the US damage a struggling Chinese economy? Certainly Trump has China in his sights. Now the US is definitely an important export market for China, with its main exports being batteries, smartphones and video game consoles. But it is worth bearing in mind that China only exports around 15% of its goods to the US. And in a way, China is somewhat prepared for Trump Mark II. For example, in the last trade war, China started to replace US soybeans with soybeans from Brazil. It has developed new export markets. It has diversified supply chains, offshoring some production to countries like Vietnam. But the really crucial thing is that China has access to many critical supply chains and raw materials. The New York Times recently reported on how China successfully damaged the US drone producer Skydio by restricting access to Chinese-made batteries. And it acts as a kind of a warning for US policy going forward. Now, last time, China's retaliation to US tariffs was fairly muted. But controlling the manufacture of many products gives China a lot of economic leverage. Now, despite China's own economic problems, especially around property and the property crash, China is still coming to dominate many manufacturing industries. Remarkably, by 2030, it is projected to have 45% of global industrial production, an impressive dominance in many industries. Despite higher rates of growth in recent years, if we use purchasing power parity, America's share of global GDP is forecast to be less than Europe and China in the coming years. The US economy is definitely very important, but it would still be a mistake to overstate its clout. Now, Trump has talked about wanting a weaker dollar because a weaker dollar makes US exports cheaper and in theory will boost manufacturing jobs. But US tariffs would, ironically, make the dollar stronger, at least in the short term. The last round of Trump tariffs caused a fall in the Chinese currency as the Chinese sought to maintain competitiveness. It's one reason why, in the short term, tariffs may have less impact than imagined. But a 60% tariff on China would lead to a big devaluation in the yuan and rise in value of the dollar. But whilst the dollar may rise in the short term because of tariffs, the longer term effects are much more uncertain, because there are many Trump economic policies which could weaken the dollar, such as a desire to run the economy hot, higher prices, higher inflation, and a pressure on the Federal Reserve to maybe reduce interest rates, possibly even increase the money supply. A falling US dollar would have a big impact, pushing up US inflation and also hurting countries who export to the US. But the biggest loser of Trump tariffs would almost certainly be Mexico. Last year, 83% of Mexican exports went to the US, $420 billion in 2022. Last year, it delivered 2.5 million vehicles to the US. High tariffs on the Mexican economy would really hurt. There are not many other places Mexican exports can go to. It would lead to job losses in the Mexican economy, which ironically could put pressure on the border, because a long-term solution to migration flows would be to encourage a stronger Mexican economy rather than a weaker one with higher unemployment. Now, one justification for higher tariffs on Canada and Mexico is the negative effects of NAFTA in the past 20 years. It really accelerated the decline in the US manufacturing base. From the 1990s, US manufacturing jobs declined as companies reallocated production to Mexico for cheaper labour costs. And this led to painful levels of structural unemployment, especially amongst blue-collar workers in rural areas and former industrial areas. And there is a consensus that the speed of manufacturing decline did cause real economic hardship for many American workers. But the big question is, can tariffs bring back those golden jobs of the 1960s and 70s? It's very unlikely. Manufacturing is increasingly automated. The old blue-collar jobs just won't be the same. But more importantly, the US economy is actually doing quite well at the moment, quite close to full employment, and firms would definitely be reluctant to relocate from Mexico back to the US with a relative shortage of labour in some areas. But when we talk about Trump changing the global economy, are we getting too ahead of ourselves? Now, although the president has all the power to set tariffs in national emergencies, maybe Congress will still try to limit the excesses of protectionist policies. Also, perhaps a much bigger impact on global economy would be from areas outside tariffs and trade. For example, extreme weather events from global warming pushing up food prices. Also, Trump's economic policies might do little to fundamentally alter the big narrative of the past 50 years, which has been a very low growth in American median wages, but GDP accelerating much faster. This video looks at the real reason why so many Americans feel the economy doesn't work for them, and why tariffs will do very little to change that.